what we are trying to do here is marry a huge macro with a lot of micro fintechs. The topic, navigating financial stability, a big macro issue, and challenges and opportunities in a dynamic global environment. How does that relate to fintechs? That's what our panel is expert at providing in terms of perspective. Now, the global environment is both shaped by fintechs and it shapes fintechs. Jay Surti from the IMF is here to tell us about how the global macros are placed. Will it be one of those seasons in the coming next 12 months where you can, raise money at 100x or at 200x or at whatever NVIDIA is quoting? Or do you think it will be a funding winter? So that relates very much to the audience here. And Michael Spiegel of StanChart is here to tell us how the incumbent financial system, the banks and financial sector, relate to fintechs. At what points is there a friction? At what points he will be able to use them for better banking? And Rajesh from TransUnion CIBIL is here to tell us how the fintechs need to help in terms of better due diligence, or in terms of perhaps understanding that, what the RBI governor said, innovation, yes, but innovation with prudence. So he's here to bring that to light. I think we have an extremely well-rounded panel. Thank you, gentlemen, for your time. Jay, I want to begin with you. If you can draw up the macro environment, both in terms of, economy and, say, private equity and venture capital, do the next 12 months or, the foreseeable future look like a robust time when the fintechs will be able to find good funding? Or do you see red flags? I mean, the Nifty is at its all-time highs. The NASDAQ is at all-time highs. So is it going to be good funding period, or is it going to be some funding winter because of a red flag?
I think, Latha, an appropriate starting point is financial stability risks from higher for longer rates. This has gradually been priced in the US, and it certainly has strong implications potentially for global markets. Now, at the moment, markets appear to be comfortable with the current outlook and scenario, but there are three things to watch out for. First, uncertainty remains high, and fiscal and political uncertainty in particular we have seen is already generating a lot of data dependence, which has led to volatility in markets. This brings me to the second point, which is emerging markets and developing economies are no longer viewed as being decoupled from US monetary policy. And third, on sectoral vulnerability, a cohort of households and corporates do appear vulnerable. So I'll just take 2 minutes to briefly go through this. On the first, on uncertainty and rate expectations, at a global level, high uncertainty has already led to volatility spikes. We've seen this in foreign exchange markets in some EMDEs. We have seen that in some spread widening of sovereigns over safe asset returns. What's important is that in the US, the strength of economic activity and sticky inflation are being reflected in expectations of increased inflation and policy rates. And what this basically means is that if there are shocks and surprises, you can expect long-term US rates and therefore global credit conditions and financing conditions to tighten quite rapidly.
Tighten going forward?
Well, it depends. As I said, if there are adverse shocks and surprises which reflect some kind of realization of risks
so
around.
You're not in the camp which says that we have already seen the highs of interest rates. You think that
I wouldn't quite say that. I think what you described as the current outlook, that there are benign funding conditions, that EM financing conditions have been good, rating outlooks have been sort of improving. Net rating updates are now in positive territory in EMDs. If you look at equity market funding costs, these are, equity markets have been buoyant, credit spreads are at historic lows, there are some exceptions. This is all true. It's just that the kind of uncertainty we have around the outlook, and particularly given that this uncertainty has political and fiscal ramifications, is still quite high. And so the likelihood of things going wrong is still high. And as a result, if some of this uncertainty realizes in the wrong way, then you could have a whiplash in markets. And so the sensitivity of US long-term rates does appear to be high relative to some of these uncertainties being realized. And my point about EMD is not being decoupled is that if US long-term rates were to go up, then this could whiplash across the world, basically. So that's where
just, I mean, this is a topic for a whole day or a couple of days, actually. But are you a believer that we will get or we are in a soft landing? Or do you think we are being too confident?
So I think it's a little bit difficult to say at the moment. Our view was, in July, about a month ago, was that the outlook was, as we described, the central outlook was looking kind of softer, but we are seeing, there are two types of issues here. One is the political uncertainty,
yes,
and that seems to flare up again and again.
Yeah.
There are two centers, at least in the world, where this is particular, but everyone is involved.
Yes.
The other thing is basically fiscal uncertainty, and public debt burdens are very high, and therefore, mistakes can be costly.
Yes.
Fiscal authorities need to do a lot to sort of tighten and lower leverage, and there's a lot of refinancing needs coming up in the next 2 years in frontier markets.
Yes.
So there are pockets of vulnerability which may actualize if some of this uncertainty kind of realizes.
Okay. So I think Jay has put all the warnings on the table for those who want funding and those who are looking at a stable environment so that business can go on for fintechs. Which brings me to the person who represents the incumbent financial system, the large bank, Michael Spiegel from StanChart. Michael, let's assume that the global macros don't get so bad. As a key banker, how are you looking at the fintech space? Do you think they are abetting banking transactions, making it easier to do due diligence, inclusion? What's the report?
So look, I think Bill Gates kind of started a big notion and motion sort of in the 1990s. So in 1990 is that the world needs banking, but it doesn't need banks. And in 94 he topped it saying that banks are dinosaurs and we can bypass them. So we saw a huge increase in investments into fintechs. And I would just add one element potentially, and that is that from an equity perspective and from a VC perspective, due to the higher interest rates, there's less patience. So I think there's a bit more pressure on startups and fintechs as well to generate positive cash flow. Now, are there positive or negative? I think generally I welcome fintechs very much, and I actually think it's been very good for the banking industry. Now, some people say banks are not innovative and only fintechs and tech companies are. I think that's not quite entirely true. My personal view is that the world will continue to need banks, and in all economies, but it needs banks that have adapted to the new norm. And in my view, and I've held this for many years, the old ecosystem of one bank to one client relationship is passé. So what we have is banks, clients, fintechs, tech companies, and ideally regulators. Now, regulators you don't really have in every market as well as you, for instance, have in India. When you think about the development of UPI, which was initially driven perhaps more from a government perspective and then taken into the private sector bank, fintechs, foreign banks invested, and now you have the world's largest fast payment system, right? I mean, you had 47%, I think, I may be wrong, in 2022. You have like 12 billion transactions a month. Just amazing. So fintechs play a critical role. We compete at times, of course, right? Fintechs shook some of the banks up, absolutely, and we collaborate. When you look at our organization, Standard Chartered, we are a global network bank. So we connect the world and we bring the world to our clients. Quite often we do this together with fintechs because we cannot develop all of the solutions ourselves. So we collaborate in many instances.
Are you at least settled on one thing? Initially, as you said, Bill Gates and a whole ecosystem of leaders almost said that banks would be replaced by fintechs. But are you now sure that it's not a question of replacement? At least the central banks are batting on your side. So it's not a question of survival, it's a question of how you will perhaps use fintechs.
I mean,
that debate is over.
So I think, but you have to, you can't stand still, right? So you have to continue evolving and adapting, and you have to take things not defensively, but you must see it as an opportunity. It's a bit like fail fast. The most important one is you always fall forward, not backwards. So you just need to continue evolving. Yes.
Fair point. Okay, let me just scratch that point further with Rajesh. Rajesh, yesterday the RBI governor spoke about a unified lending interface. Can you say that fintechs have been able to speed up the banking process?
Oh, absolutely. I think when you look at, let's first talk about the ULI as a national infrastructure. We'll link it to your question and the core of our topic, so to say. First of all, as a national public infrastructure, digital public infrastructure, I think it's such a natural progression, right? Many years ago, we started talking about the JAM Trinity, and as the governor says, the JAM Trinity, and then obviously payments, UPI, we spoke about this, huge volumes on UPI. It's just so natural, it's just pure natural progression to go on to ULI next, where you have all these disparate data sets which are not talking to each other today. And I do believe that we have an important actionable there as an industry. We have GST information, we have NPCI information, we have a whole lot of digital public goods, but all of it is not easily available to everybody to still use it. And to start with the agri side, let's say the more needy segments on the agri side, small businesses, to start with that on the ULI with the banking system, and then obviously very soon it will be available to everybody, including fintechs. I think it's a huge step forward. From a very infra perspective, like I said, you can so easily get access to all data. Then let's talk about the borrower, us the individuals, right? You really look at most of these kind of transactions, it really is totally based on trust. A borrower and a lender can be in different parts of the country. They don't know each other, more so with all this digitalization and digitization that we talk about. They don't know each other at all. It's totally based on trust. And how do you develop the trust with a stranger who you don't know at all? Then it's good quality information, right? So for the borrower, platforms like this or infrastructure like this at a national level provide us the ability to represent ourselves well. I don't know what to give the lender today, and the lender doesn't know what exactly to ask me. It's all more towards convenience. If it's all digital with a consent and seamless and frictionless, then everything that the lender needs to know about me, it's so easily available, process it. So it's good for the borrower. And lastly, for the lenders, as we briefly touched upon in our chat while we were waiting, today when you look at the fintech world and a whole lot of these digital public goods and infrastructure, it's all a little fragmented again, right? So even for the lenders to take advantage of this lovely digital stack that we are developing as a country, even for lenders, it's very difficult and challenging to go integrate with each separately. You have one good unified platform. So it's a win-win progression. And coming to the fintech's point about banking, it's going to be very interesting. I was on the other side in the banks when, like he said, Mr. Gates said what he said in '94. I used to work for a bank where people used to come and say, in 5 to 10 years from now, your department won't exist, your job won't exist. Most of the people in your team won't have jobs, right? Because the technology will replace those jobs, etc. We will go through those cycles. I hear similar stuff now about AI. Right? Just like with the economic cycles, right? We all go through the cycles. When you look at it in the short term, it looks much more intense than it is. But over a long term, it all evens out. So to sum up the last point on this, I think some of this infrastructure will further help the fintechs, who in turn will further compete, collaborate, or work with the banking system. It's a win-win for everyone to progress, I guess.
Jay, as a regulator, I mean, you represent the regulator in this discussion. Are you worried about technology as creating sudden risks? Like, you know, Microsoft 365 and CrowdStrike, suddenly you couldn't fly, airports, banks, everyone. What's the IMF point of view in terms of cyber risk?
Yeah, sure. So we are all aware of what happened on July 19. Windows machines worldwide began experiencing crashes due to a faulty channel update to CrowdStrike Falcon. Now, this outage was not triggered by a cyber incident. There might have been some threat actors who tried to take an opportunity, but this was really not. This was an accident. But nonetheless, there was widespread disruption that was experienced across sectors. CrowdStrike provides cybersecurity solutions that are reportedly used by some systemically important banks globally and also by critical FMIs. And so the impact on the financial sector was, while short, quite significant. So, you know, the CrowdStrike incident brought home potential systemic risks in the technology domain that are really embedded in the supply chain, notably third-party service provision, concentration in critical service provision, and single points of failure. And I just wanted to spend a couple of minutes reflecting on the intensifying cyber threat landscape and what it means for financial stability. So we presented some analysis in our April Global Financial Stability Report in a chapter called Cyber Risk and Financial Stability. And basically our view is that although cyber incidents have not so far presented systemic threats, you know, if there is a significant cyber incident at a systemic financial institution, this could pose potential macro-financial stability problems. And in fact, central banks and regulators are already viewing cybersecurity risk as a material risk and actually as a source of potential systemic risk to financial stability. Now, one thing is there, which is whether we like it or not, cyber incidents are going to continue to occur. And what this means is that when in terms of response, while protection measures, ensuring that they are adequate is actually very important, it's really what the response and recovery preparations are, which is really of paramount importance. Things like, you know, computer emergency response teams and their financial sector version, the FinCerts, and critical infrastructure protection agencies are already, but in fact in the future are going to play even more prominent roles. And, you know, at the national level, governments need to engage with supply chains to minimize incidents and to establish backup arrangements, not just with tech firms, but in fact with the power and communication sectors. I mean, if you mention regulation, from a central bank's point of view, in order to do its surveillance role properly, more and more central banks should begin expanding their vocabulary of stress testing and systemic risk analysis to incorporate meaningfully cyber risk stress tests.
Michael, just coming back to this cyber risk, you know, there was a time when banks wanted to host everything in their own servers. But now you just have to go to cloud because it simply expanded and the fintechs threw that challenge at the banks. What do you perceive? I mean, you have to share the data, you have to put it out there in the cloud. So how are you looking at this risk, which may come through fintechs, which may come regardless?
So I find the topic of cloud very interesting because there are so many different clouds. You have your private cloud, which is your own data center. And then you have a private cloud where somebody else manages the data center for you. Then you have a private cloud where you sit in a public cloud, but it's isolated, you sit in a public cloud. Let me just be clear, banks do not openly share data, full stop. We're probably the most regulated, and that's a good thing, right? We do not share data, right? So if anything we share would be metadata, completely anonymized.
I take your word for it.
So just on that one, we're not going to put on things. And so where do we, so we're in some markets, we're in the cloud. So I'm rolling out a latest tech stack global payments platform, which is already in India because India is a very demanding market. So you want to be on the latest technology that is cloud native. It is microservice enabled. You can parameterize it. It is a great system. It does sit in the cloud in India. It does not sit in the cloud in a few other markets because of local regulatory concerns, or shall we say considerations. So it's not one or the other. It is going to be all together, right? And more countries do actually go and require data localization, but it doesn't mean that you can't have it in the cloud. Because there's no such thing as a thing in the cloud globally, right? I mean, the data sits either in the country like India is data localization. Many other places are, and so we had to put more servers in here, which is a good thing, right? And fully understand where they're coming from. And then there's more global sharing, but generally it's anonymized, and that is something that probably will go from a supervisory perspective, will probably broaden beyond the banks over time, because that's one of the considerations regulators or supervisors have, that there's a bit of an uneven regulation at time, right? And as you said, I mean, you don't regulate some of the large tech financial services back at the home country because they don't want to become a bank or a fintech at home, but outside they do that. And I think that will get harmonized over time. At the end, I just want to emphasize that again, it is the collaboration that's going to make this all work. None of us can do that on our own. Also not the large tech companies, they probably have most of the resources. I want to say one more thing to fintechs. And our previous, or two previous speakers, and I have to look up, so Sri Mahavir Singh said something very interesting. He said the private sector and fintech are critical for further development and inclusion. I think fintechs have brought a massive benefit to financial inclusion and make more people bankable. And this is a great success and a great benefit we drive, and we can actually benefit from this together. So I think that's a good thing.
Rajesh, I think the big point, and you are, in CIBIL, you are looking at credit scores or designing credit scores. Do you think the big support that fintech can give to the entire financial sector is improving diligence?
Oh yeah, absolutely. I think that's very important. One of the key points, or I would say answers that I am yet to be fully convinced about is the differentiation that fintechs bring to the traditional banking system, or let's say overall across the products and whatever business models. So what exactly is the differentiator has to be defined well. I think so far what we have seen a lot of is convenience for sure. And because the fintechs operate primarily in the digital world, obviously there is much quicker processes, right, versus the physical processes. That's a no-brainer. So when you talk about due diligence, I think a lot of work to be done there. We spoke earlier about these nice platforms and data sets, but the real usage is to come out. And few areas where I think it will help when we talk about due diligence, right? We're talking about new to credit. And we know that in India, given our goals on financial inclusion, given our demographic composition, right? Such a large young population.
Given our informal economy,
credit as
you don't think that fintechs will?
Absolutely. There's such low credit penetration. This is where I think there's a huge opportunity for fintechs, MSMEs again, right? And we'll link all of this to due diligence to say that how do fintechs use their innovations and their superior technology to bring in this due diligence, right? Now, it can be traditional data, it can be alternative data, it can be behavioral data, obviously within all constructs of privacy and consent-based, right? So I think when it comes to due diligence, what new information can you bring which can give more confidence to lenders? And my last sentence on this, I think the fintech world we can probably say that the fintech world has really arrived or reached its point of arrival. I think I would kind of accept that on the day when we say that new to credit versus existing to bank. On the day that we say these two have been equated. Because the only real difference is only information. Latha could have an account with a large bank. She could have a savings account, credit card. She could invest through that bank. They know everything about her. So it's easy for the bank to do due diligence on her, right? But let's say there's a youngster who's just got his first job and he doesn't have that many accounts with a large bank. That's a great opportunity for fintechs, but that is the real innovation for me. I think just information moving quicker for a faster process, it's just the beginning then.